Facebook will report fourth quarter results this week, and to prepare, we're going to take a look at where consensus estimates stand relative to management's guidance. To access management's guidance, you can go to the Investor Relations page and click on the transcripts. We've downloaded a copy in a PDF and highlighted the details, so you can see that it starts on page 8. And if you'd like to download our earnings model and follow along, please visit our website, gutenbergresearch.com. From the home page, you can click on the Free Models tab and scroll down to Facebook. You can see clicking that button, it'll pop right up. And if you're new to our approach, please click on the Education tab and download our model overview document, which describes our entire approach. And in this document, we use Apple Inc. as an example, but the methods for all of our models follow the same approach. And with that, let's get started. So the first piece of guidance that management gave us is on revenue, and it's not something that we can actually input into our model. It's just general revenue guidance. So they say that the US dollar continues to strengthen, so they're going to continue to face currency headwinds. So no real guidance for the revenue line. But they do give us guidance for full year 2015 GAAP expenses, which they expect to increase by about 55%. So if you take a look at our model, you scroll down below the segment details, you can see that we have, and this should actually be purple to indicate that this is in line with guidance. So this is taking the growth rate of all the expenses, since that's how management measures this line item, from last year. And we have calibrated our model to meet that 55%. The next item that management gives us guidance for after the expenses is Capex. So they expect full year 2015 Capex to be in the range of $2.5 to $2.7 billion. And we keep Capex in the cash flow statement, and you can see that we've modeled it right to 2.75, so the midpoint of that guidance, which means Capex for the fourth quarter will be much higher than all the other quarters this year at just over $900 million. After Capex, they gave us guidance for stock-based comp. So this is going to be a non-GAAP item. So they say it's going to be in the range of $3 billion to $3.2 billion. And you can see we keep our non-GAAP items in their own category at the bottom of our ratio section. So this section here goes through the non-GAAP adjustments. And it's made up primarily of share-based comp in this case, and a little bit of intangibles, amortization of intangibles. So they gave us guidance saying $3 billion to $3.2 billion, so we've modeled it out to the midpoint at 3.1 and split it between amortization of intangibles and stock-based comp. But they also gave us guidance for intangibles, so between the amortization is going to be between 700 and 800 million. So we've also kept this at the midpoint of that guidance as well. So you can see that's the next item here, 7 to 800 million. Finally, they give us the full year and Q4 non-GAAP and GAAP tax rates, which they say are going to be several percentage points above the rates from Q3. So that's a little difficult to model. And essentially what we did here is we know that we want to get our final EPS estimate to be in line with consensus estimates at 68 cents on a non-GAAP diluted EPS basis. So we solved for the tax rate that would get us there. So we need to basically have a tax rate of about 41%, which is definitely several percentage points higher. And this is going to be the main driver of the difference if there is a beat or a miss for the fourth quarter. So we don't have a lot of guidance on the top line revenue estimate. We don't have a lot of guidance on tax, and the only item that they really gave us solid guidance for was the expenses. But even still, it looks like consensus estimates are in line with the general guidance that management gave us heading into this quarter. So now that we know that our model is calibrated to meet consensus estimates, we can scroll down to the valuation sections and see how we look heading into this release. So on our market multiple basis, we have our multiple valuation set to 37 times the next 12-month consensus EPS estimate. So that's about the average over the last 3 months. That would give us a price valuation of $104 per share, which is a little ahead of Friday's close of around $98 a share. So if you'd like to change this multiple, you can do so if you want to make it in line with that $98. And then on a discounted cash flow valuation basis, keep in mind we did decrease the volatility this quarter from last quarter, so we're down to 17%. And we changed the interest rates as well to reflect where they stand relative to last quarter. Just keep in mind that if the Fed does increase interest rates through 2016, and if volatility continues to be high, and right now it's above 17%, then that would have a pretty big impact on the DCF-based valuation. If you'd like to download this model, you can run some sensitivity analysis on the operating metrics ahead of this call this week. So for instance, we have modeled out the monthly active users for each region and the average revenue per user for each region. So you can change these growth rates or change these dollar amounts, so these represent the dollar for each user in each region for the quarter. Or any of these other metrics if you want to see what kind of impact they would have on earnings and valuation. It's pretty easy to make the changes here. And be sure to check back after the call. We'll update this model and see what the impact on valuation is. And also join us later this week for the Amazon release, the Microsoft release, the GoPro release, and the Alibaba release. If you're interested in financial modeling, be sure to subscribe to our channel, and thanks for watching.